Yeah, Zhang, you can take the
it's my turn. Okay.
Yeah.
Oh, hello, everybody. Good morning, good afternoon, good evening, depending where you are. So thanks, everybody, to join this talk, to listen to me. And for me, it's very much a learning experience as well to think about some questions about standard setting, especially about financial statement design. So thanks to Yong and Steve for running this very meaningful project, accounting design project, which I think is very unique for academics in accounting. And I think it can be very important for thinking about some fundamental questions for the field. Okay, so the title is A Basic Theory of Financial Reporting, Designing Financial Statements to Serve Investors' Needs. So here is the agenda. I will talk about the research question, explain it first, motivation, and a very simple theory, common sense-based theory. And the main part of the talk will be on the implications of the theory for standard setting. In particular, I would like to make reference to IASB's conceptual framework regarding how to design the balance sheet, how to design an income statement, and the interaction between the two main financial statements. So I will welcome people to make comments or ask questions anytime during my talk, all right? So the research question is already in the title, how we should design the balance sheet and income statement to serve investors' need. So here I'm looking at equity investors' need, who is a primary user group. Now, I understand that the financial reporting is for general purpose to serve many different people, including other people like creditors, but in my view, we need to understand the needs of each one of them clearly so that standard setters can understand what they're doing and how to consolidate, how to combine the different needs if there are inconsistencies, in what ways they are inconsistent, and in what ways they may be compatible between different users' needs. So it is up to the standard setters to make a choice before we have understood clearly the needs of different groups. And so I'm going to look at what are the essential choices the equity investors are making. And in making those choices, what kind of specific financial reporting information they require for their decisions, they need the most. Now, when I look at the literature, it seems that we have very little research to address this question directly. That is how to design the balance sheet, how to design the income statement, even though we use it. This is the main part of the financial reporting. It's very important how to design the content of these financial statements. Historically, there have been some discussion, some debate. In the 1970s, for example, people had debated about whether it is possible to formulate accounting standards that can be unanimously supported by all economic players in a multiple person, multiple firm economy. And people disagree as to whether it's possible or not possible. Now, I do not claim to be an expert of that line of research, and I'm going to take a different approach to address the question I have posted earlier. But that debate did not go very, very far because people disagreed and people basically stopped thinking along that line, along the information economics, how to partition states of the world, how to resolve uncertainties through accounting systems. But I'm going to take a somewhat different view as to how we should think about the financial reporting problem. On the empirical side, there have been some studies addressing specific accounting standards. But these are not normative studies. They are involving limited choices between, say, the standard choice option A versus option B. This is based mainly on the empirical approach. So in other words, they have not looked at the question in a general sense as to how to design the whole content of these financial statements. And when you look at the standard setting arena, the two main financial reporting standard setting bodies, they have their own conceptual frameworks. But I think these frameworks could benefit from having a more rigorously and systematically developed theory of financial reporting. Now, my personal understanding is that they do not have a well-developed theory to closely guide the conceptual framework formulation and subsequently how to do formulate financial specific accounting standards. Instead, these conceptual frameworks have focused on some qualitative features. The things like usefulness, relevance, or faithfulness. Now, I think these features need to be assessed, need to be determined in the context. Because when you say, well, you can't, for any piece of information, you probably can always find a setting, a problem where that piece of information is relevant. So in order to make, to determine what is relevant, what is not relevant, we have to be more specific about the context, the decisions being made by main users. And from there, we can determine what information they need the most. And then we can assess what is relevant, what is not. And then in terms of reliability or faithfulness, these have to be judged in relation to what is relevant. Because otherwise, you cannot really be so comprehensive in terms of being faithful and reliable in representing every part of the world. All right. And also we understand that the conceptual framework are subject to ongoing changes and revisions, which seems to suggest that the standard setters are not too satisfied about what they have, and they need to make improvement. And I think if we have some kind of theoretical guidance, more closely providing guidance for their thinking, perhaps we can develop something more permanent as the basic part of the structure of this financial conceptual framework. So
Guochang, I think
there are a lot
has
of
a question there.
I'm sorry, sure.
Yeah.
Hi,
Yes. Yeah, hi, Ayo.
Yeah, I have two questions. One is related to this slide. So previously, before your talk, I mentioned that I think for those FASB or IASB, before they actually draft a new standard, they tend to actually have different meetings with different user groups, right? Small business owners, their creditors, large equity investors, or different natures of their investments strategies. So my first question is that what do you think academics' unique contribution to this discussion when they design a new standard, given that those standard setters has a direct interactions with users in practice? Like what exactly the specific theory or construct or structure that's actually would benefit these ongoing interactions between them and the practice?
Right. It's a very valid question. I think academics can provide insights that may not be apparent, obvious to all investors, all users, okay? One example I have in my mind is, say, investors are making choices in capital markets, they want to make investment decisions, but it is the capital asset pricing model that provides them with the insight that they should focus on systematic risk and why it is important. So before that theory was developed, investors may have their intuition, but people may process information differently. I think academics may be able to do something like that, even for the financial reporting aspect. Because if you ask 10 different individual investors, you probably get multiple answers as to what part is important, what part is not important. But if we can stand at a high level to conceptualize their problems, to think about exactly what the essence of the decision is, and perhaps we could provide some insight. Right.
So I think that you're calling for more research on, for example, how do we define asset in the balance sheet? What's the optimal aggregation from transactions to the report, right? Like all those questions you kind of posed in the
I hope I'm going to, maybe I will defer the specific discussion on this, because I'll talk about the conceptual framework of ISB and their definition. Now, if they have got a very clear idea about what investors need, then I would expect them to provide a more clear definition of asset. So perhaps they can at least do further thinking and processing as to what the needs are. And we can have more specific discussion there, I think, on this.
Thank you.
Right. Okay, so these are the kinds of questions I think are very important for standard setting purposes, especially at the conceptual framework level. And I hope to shed some light on these questions, these aspects. And so I'm going to provide a very simple, common sense-based intuitive model, the way to think about financial reporting problems. So this simple economy has two layers. One is at the bottom, the real sectors where individual firms need to make real investment decisions requiring resources. And the objective here is to generate value, but they need to have resources for that purpose. And the capital market, the function is to gather resources first from all the people who are willing to invest, and then distribute resources among these different firms and projects which they think are worthwhile. Okay? Now, so capital flows this direction, and information needs to flow this direction from firms to markets to investors. And one part of the very important information is about the firm's operational results, because how do you convince investors that we are capable of producing value from resources? The one very good proof is that you have done this successfully in the past. So the assumption here is that the past data and operational data can help investors to assess firms' ability to generate value from resources. And what is interesting and very convenient here is that the capital resource is standard resource. It can be distributed to any of these projects. And from investors' point of view, they don't care so much as to what exactly these firms are doing, the products, the business model. What they care the most is what is the ability of convert resources, the input into output. So this is, it's similar to a kind of resource allocation problem in a multiple division company, except that there the decision isn't made by authority, by the company top level, but here it is through the market mechanism. So I'm gonna probably talk not too much about the theory itself, but rather the intuition here I want to make clear is that the attribute that investors would like to understand about these firms is their ability to convert resources, financial resources, into value. And they will compare between the different firms. So that really involves the trade-off between input and output, which is the cost-benefit trade-off. Okay? Now, the problem is that the ability is not observable. Even for managers, you cannot really perfectly know or observe the ability of the firm. So this has to be inferred from what has been realized from past activities. So what can be reported is really the observable aspects of the firm's operation, which is the resources, financial resources that you use, which you can measure in monetary terms, and also the output also measurable in monetary terms. It's all standardized and comparable across different firms. All right, so this is the basic idea, the kind of the problem that my thinking is as to what is the financial reporting for, and the essence of what is the purpose of financial reporting. Okay, any question on this? Because because of time, I will not talk about the details of the model.
Yeah, I have a question, if you don't mind, Guochang. So,
yeah.
like initially, first, nice to meet you. So I totally agreed with your initial motivation there when you pointed out that this is generally an issue that involves a lot of stakeholders, right? Not just a firm and an investor, but also governments, bondholders, and others. And when I now look at your model, I feel like there's a bit of a disjoint there between your initial motivation there and then what you show here. So why do you choose a framework like that over like a more extensive general equilibrium framework, like, for example, Kitland-Prescott 1982?
This is a very simplified general equilibrium framework, because I'm going to show that certain decisions equilibrium will lead to Pareto optimal, which means that the value maximization for the whole economy. So so you are thinking some aspects that's missing in the model.
Players, right? So I mean, when you started with your presentation, you were talking about that financial statements are general purpose, right? And I guess like the main players.
Yeah, okay.
I would typically think about, and I think also the FASB and the IASB are thinking about, are investors on the one hand, of course, bondholders, employees, governments, consumers. There's a fairly wide range of players here, and
I understand your point.
Like what you're showing here is, I guess, 2 players, right? So it's very specific.
Very simplified. Yeah. So when I mentioned that the financial reporting is for general purpose, I was acknowledging that in practice, in the real world, it is for general purpose. But my purpose of the study is not to study all of them at the same time. So my intention here is to pick one of them to start with. And I said, we need to understand the decisions of each one of them. So I'm just focusing on one first, right? Rather than inviting another player in, like a debt holder, and then to complicate the problem. Because what I think is that the results derived from this context can be generalized, even if we introduce an additional player, additional user. But just to say what equity investors need, it's okay to just focus on this player alone. And but next step, people can think about by introducing the next player, how things may change. But the general idea here is that equity investors need to make a comparison as to the input-output, the transformation by different firms. Steve, you have a question?
Yeah, I just agree with you. I think your choice is a good one. It all depends on the user, as you point out at the beginning of your presentation. After all, interest expense, we seem to deem the expense for equity investors, but it sure is an expense for bondholders. Interest expense is income to the bondholders. So the idea of general purpose financial reporting sounds good politically for the boards, but you can't do it, and that's part of the Dembski paper. You've got to who is your user, and you account for them, and maybe a different accounting for equity holders and a different accounting for bondholders. My own bias, I call preference, is that you think about equity holders first, because institutionally they're the ones who sent the reports. The audit committee who represents the shareholders govern those reports. So it's a very natural place to start. And after all, if you look at the accounting system, it's an accounting system about updating shareholders' equity. The last entry in the accounting cycle is the closing entry. You close earnings to the book value of shareholders' equity. So nominally, it's a system for updating shareholders' equity. So I think you have to make a choice of what peg you're going to hang your coat on, and I think you're making a good choice here in the context in which accounting is practiced.
Thank you. Yeah, I agree that the problem, that the whole problem is much bigger. But let's start with someone who has a unique role in providing capital and then the residual claimant, and they care about the risk, more than probably other stakeholders. So anyway, people, I think this is a very complex problem, very challenging problem, but I try to do this in a more workable way, start with something simplified, right? So I hope I have conveyed the main idea from this simple context, which is the key construct that investors would like to know is about the input-output relationship by that the ability of each firm to generate value from the resources that they are providing, and they're going to make a comparison. But that information is not directly observable. We have to infer it from reported numbers. So what do we use? We use one part of the information is the output, and the other part of the information is input. So that's the direction I'm going. And skipping the technical aspect, that's basically is to describe the idea in more detail. The one result here is that we get an equilibrium where the firms are going to make decisions based on the NPV rule. Okay, so whenever there is a positive NPV project, they will take it, and otherwise reject it. And investors are going to behave competitively in the market, pricing each individual firm stock based on expected cash flow. And there is no agency problem here. So what you can think about is a very, very basic financial reporting problem. It's like extended version of MM context. But even in that context, there is a financial reporting issue because we cannot assume that information is automatically known by the economic agents. We have to have a means to communicate, let people know the information. So this is an additional element, a layer that's being added, imposed to the M&M's perfect world. Otherwise, there is no information, no agency problem. Okay, it's just that to acknowledge that in the MM world, we need to worry about how information should be produced, should be reported and represented, especially. And in this context, the equilibrium is Pareto optimal because they are making efficient decisions based on whatever information is available. So the implication is the main result of the model is that we need to have at least two financial statements. One is to record the cost of using the resources provided by investors. Now, this cost and benefit is defined from the perspective of equity investors. Okay? So equity investors are providing resources, so they bear a cost in the sense that they have to sacrifice consumption for this, but hopefully they can earn a high return. At the same time, the report needs to provide information about the benefit in the sense that the company is generating value that can enhance individual investors' consumption power. Okay? If it cannot enhance the consumption power, that's useless for them. So the welfare is defined in terms of total wealth, which translates to consumption. So it's a very simple idea. It's economic-based cost-benefit analysis that the investors need to perform, relying on the financial report. So the rest will be all the discussion about how we should think about the balance sheet and income statement coming from the idea, using the idea coming from a simple theory. And I'm going to make a reference to ISB's conceptual framework, which is recently being revised. I'm not as familiar with the FSB's conceptual framework, but I think to the extent they share similar ideas at a very basic level in designing this conceptual framework, then some of the discussion can be also applicable. All right, first, what is the boundary of the balance sheet? So according to the very basic theory I have explained, the balance sheet should provide a full account of the investment cost borne by investors. So all the cost, the resources being provided at the original cost, original amount. And this would include both tangible assets and intangible assets. These have to be included because both, in principle, both represent part of the resources coming from investors, the cost they bear. Now, I am not thinking about implementation issue. So when this idea, if it is used to guide actual standard setting, then they need to worry about whether it's feasible or not to measurement, in actual practice. So at least we have a starting point. We have some ideal kind of target we want to achieve. And so how much this could be achieved, it depends on the practical issues and some imperfections at the implementation stage. Now, when I look at the ISB's conceptual framework, here is a definition. An asset is a present economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits. I feel this is pretty vague in terms of what kind of resources should be included, what kind of resources should not be included, because when you just look at the definition, you might conclude that all resources satisfying this statement may be a candidate to be included in the balance sheet. But then you would think about things like, human resource. It is a resource, I think it satisfies the definition here from the ISB's conceptual framework. But from my simple model, investors are not so worried about human resource aspect. At least they do not need to use the information in the same sense as for financial resources that they provide, which is a stock variable. What is the amount of money they have provided? Now, if you translate into something equivalent on the human resource side, you might want to measure the total amount of the manpower that the company has. And, disregarding other issues like legal issues, whether you can own people like slaves, I don't think that information is of equal value, of equivalent value for equity investors. So perhaps there is not as such a need for recognizing, at least not recognizing all the whole amount of human resource. Perhaps I might say that the amount of financial resource being used to enhance human resource, to enhance future productivity, that could be included because that would be part of the cost that investors also bear, and then that would translate to future benefit. But when you look at the stock amount, the amount of total manpower that really relates to past education, past experience of these individual employees and so on, this is not the equity investors' investment. Anyway, I see a hand, Ayong.
Steve, do you have a question? Do you want to go first?
Oh, Steve has a question.
Yeah.
Well, I did. I turned my little hand off here because I think it was answered in the following, in the last statement you made. We talk about the business as financing activities. We raise capital, let's say from equity investors, and then we invest in assets. Okay, so I think under the accounting model, the idea that a human resource or that you're situated in the country with good rules and law and order and so on, less corruption. These can't be taken as assets. You've got to take the investor's fund and actually apply them in a transaction to the investment. So that rules out human resources, unless in fact you actually invest in human resources. And then it's a question of whether you want to recognize an asset. But the idea that you recognize all these relations with suppliers and customers as assets, where you haven't really spent a penny on it, it seems to me outside the bound of the setup of the accounting system, which is to take the investors' fund and invest in assets. If in fact you do a lot to develop customer loyalty, for example, then it can be an asset. So I think that constrains it. You're right, it's not in the definition, okay?
Right.
But the assumption is here, it is a system of giving up consumption, give cash to the firms and taking that cash, investing in assets to generate a higher future consumption. So it's a transactional analysis that rules these things out.
Yeah. Yeah. Ayo?
I think when I read your write-up piece, I think what I kind of struggle with is initially when I look at the front end, I thought that this is a kind of a mathematical optimization exercise, that you try to combine a capital market like asset pricing model with the IO model with a firm's production function and have a general equilibrium. And I was looking for your assumption about information friction. But I think what you derive is just that marginal productivity from the firm will be equal to the marginal kind of like return to the investor. And then that kind of leads me to ask this question is the goal of this exercise is really try to solve something that we have not seen in the theory before, or it's just simply just a normative piece that try to rationalize whatever being picked by the FASB or IASB. We try to kind of rationalize why the rules are written this way with some intuitions. That what's the purpose of this exercise?
The purpose is that we need to have a better understanding of exactly what kind of transactional data will be the most useful part of the information for decision-making purpose. I personally don't think that question has been well answered. We talked about all kinds of, there are a lot of data, numerous data items in the financial report, but exactly which is the most essential and why it is most essential. So it comes down to investors' decision to based on cost-benefit comparison. And to make that comparison, we need to have a very clear signal about how much is the cost and how much is the benefit. So we want a financial report to be designed to convey that information in the most clear and direct way. So it is still to better understand what the financial statements need to do to serve the purpose of the investors well.
I think, but like related to your answer is that what I was a little confused is that the paper seemed to only talk about one particular selected choices that is in the standard. There's no alternatives. If the exercise is try to think about from the transaction to the aggregated reporting, and it's a design issue, I think at least there will be like at least more than one choices for us to evaluate.
I do not think that way. I'm open to any choice. Okay, it's not like A versus B. I do not have predetermined limited set of choice. I am open to anything as long as it comes to what's being best for serving the optimization problem, and which is to maximize the value generation. So whatever comes to serving that objective, it will be the choice. So anything else would be a candidate, but they are not being chosen because they do not serve the investors' need more directly. Okay.
Yeah. Hi, Guochang. I'm like jumping in because I'm the co-host here and I cannot really raise my hand. So
you can raise your real hand.
Okay, yeah, real hand. So I think I agree with a lot of what you are saying, and I think my question probably is more specific. So we know that financial reporting is really important because usually companies' operating cycle is way longer than the reporting cycle, right? So like in your model, you sort of assume like in each period, the company sort of finishes one cycle, and then we can use their past performance as input to evaluate their potential for future investment, right? But
Mm-hmm.
I think a lot of those devils are in details. Like think of the measurement of balance sheet, and I have another example for income statement. So suppose, say, Pfizer, bought a company, a startup. So like you would suggest, yes, in order to evaluate their decision useful, their quality of their decision of this acquisition, we should record this purchase at the acquisition cost, right? But
yeah, I will talk about that in a few minutes. Yeah.
Yeah. And that maybe I'm jumping ahead of myself a little bit, but like say if the purchase was made a little bit later than they made, and the purchase price, say, is twice as high as if they purchased it earlier, then the acquisition cost would be very different. And here comes the question, like if we evaluate their operating effectiveness, so like it seems the latter decision usefulness would be quite different. If you just evaluate the latter part, you would assume, right, now the value of that asset is actually the higher value, the fair value in the market, just because now the market come to the realization that this piece of intangible is actually much more useful, much more valuable than you had acquired it for, and thus our evaluation of your operating performance should be actually based on the more useful fair value. How would you think about that?
Well, I hope to be. I want to comment on the usefulness or not lack of usefulness of fair value in a few minutes' time. Okay. So I
cool.
try to
Thank you.
Ask you guys to stick to the very basic model, the very simple idea as to the two pieces of information. One is about input, one is about output, and the actual cost rather than the later revalued. And so I will talk about each of these issues one by one. Right.
Yeah.
So the time it's very strict, right? Because the way it's going, I don't have enough time to finish. So, okay. So I have another hand, Wang Pengguo. Yeah, go ahead.
Professor Zhang, when their balance sheet and income statement and earnings, book value jointly in action in valuation. So because they are jointly in action in valuation, so why the boundary of this balance sheet is that particularly important?
Well, they joined to make you join as in this model. Actually, I am conveying a message that the two pieces of information needs to be used jointly so that you can infer the ability of the firm of converting resource to value. But in order to provide that signal, joint signal clearly or accurately, you need to measure the numerator and the denominator both clearly. All right. So if the denominator, which is the asset here, is incorrectly measured, if the boundary is too big, too wide, then that information is distorted, and then the signal, like profitability, the ratio will also be distorted. So each one of the two pieces, both pieces need to be accurately measured.
Yes, because if you talk about ratio, for example, return on equity, if there's some error in the denominator, and then if you have the counter measurement error in the numerator, and then the ratio will not be affected. Well, so that will relate to your boundary of balance sheet, and then this is conceptually you will talk about the boundary of income statement, right?
Yeah, of course. So both pieces have to be measured accurately. So we do not rely on having an so-called appropriate amount of mistake in the numerator to correct the mistake in the denominator. That's not the right way. We wanted to get each piece correctly so that we can be more sure that the signal, the ratio will be more correct. Okay.
Okay. Yes, thank you.
Okay, so these are the comments. The definition is too broad, too vague. Some of the aspects which clearly seem to be clearly meeting their definition, but it's not feasible to talk about these growth opportunity, things like that, because we also need to stay with what has happened and realize transactions. And on remeasurement, which Zhang just mentioned earlier, if you wanted to get a clear signal about the firm's ability to transform resources into value, then remeasurement will not be helpful, because this is using fair value that would distort the amount of cost that investors actually bear, because that's not what they provide. Okay, and so this is going to subsequently destroy the inference they make about firm's ability, because it's just like when you accept a project, you have NPV assessment ex ante, ex post. You wanted to go back to evaluate, re-examine your project success. You will compare the actual result with the actual cost at the beginning, rather than the fair value, restated value at some point later, because that's not the exact amount of cost that investors provided. And elsewhere, I just want to mention that I'm here focusing on the real activity, but if you are talking about the exchange the exchange sector, the market setting, trading activities, then it becomes a different story. Their fair value will be directly translating to the gains or loss for the investor, the person holding the asset, because that is a completely different kind of a business model. But that's outside the picture here. And another thing is about the measurement basis. The conceptual framework talking about multiple options, alternatives, historical cost, current value, including fair value and value in use. And they talking about the factors to consider when selecting a measurement base, things like relevance, faithfulness, and so on. But again, you cannot really make choices out of context. And in this particular theoretical setting, at least, it is the historical cost that should be used. As I said, that's the actual cost borne by investors rather than the fair value. About intangible assets, and we mentioned a little bit about this. In principle, it needs to be recognized because it is a part of the resource spanned from investors' point of view. Okay, but it needs to be recognized at cost. That's the implication of the theory: cost of either purchasing or cost of internally developing these intangible assets, not the current value. Steve?
Coming back on this point here, and coming back to Penghua's point that the income statement and the balance sheet are produced jointly, your idea is you want to have the investments that we invest in the denominator, and the return, the earnings we get from those investments in the numerator, so we get a good rate of return on investment. Now, there's a problem, because if you put an intangible asset with low probability of outcomes on the balance sheet, let's say R&D into a drug for pancreatic cancer, the probability of that paying off is very low. Let's say 5%. Mm-hmm. Now you've got to establish, you put it on the balance sheet, pretending you have collateral, and then you've got to fill another problem. The balance sheet and income statement work together. That has to be amortized. What's the amortization schedule? You're going to have a crazy amortization schedule, which every year is going to be adjusted for re-estimations, impairments, and all sorts of things. You lose your information in the numerator. You don't get. So you cannot talk about, in my mind, you cannot talk about balance sheet without thinking about the effect on the income statement, and that, in fact, is the rationale for why you don't put R&D on the balance sheet, or one rationale, okay, because it screws up your income statement. So it's a double entry system that has both. You can't think of one statement and the two statements as separate statements. What you do on the balance sheet has implication for the income statement. So that I think that's a very important point that it's not understood. Now, in the conceptual framework, they have their definition of an asset, which we can modify along the lines. They would say under control in the past of a result of a past transaction, and it actually satisfies the criteria you're talking about. But then they go on in the implementation section, I think it's paragraph 5.25, it says uncertainty enters in. That's the definition of asset, but you can't recognize it if there's significant uncertainty. Okay.
I agree.
So I think you've got to always talk about these two statements together.
I agree that the model will not be able to take care of many issues at the implementation level. And so big uncertainty is one hurdle for recognition. And so as I state here, it's purely coming from a simple theoretical context. And so when the actual choice is being made at the standard setting level, then the people have to think about, whether it introduced some problems and liability.
No, but I think investors well understand they make investment decisions under uncertainty. So you can't sort of separate that off. You've got to say, look, this is my problem. I'm investing under uncertainty, and I want to sort of deal with the risk. So I don't think you can separate that off as a theoretical slice of the problem.
Well, it's just a simple theory which needs to, before we think about those additional issues, then this is so far the implication. That's all I can say.
Yeah, yes, I see that. But you're actually talking about accounting under certainty, and under certainty, accounting goes away. Okay, the basis for accounting is uncertainty. If you want to start talking about accounting under certainty first, how it would work perfectly under certainty, it's a straw man because there's no accounting under certainty. Uncertainty is the context which the investor deals with and the accountant has to deal with.
The model does have uncertainty. It's just that when you have something with significant uncertain payoffs like R&D that you mentioned, then the recognition and amortization, these becomes very problematic at the practical level.
I see. Okay, well that's fair. That's good. That's I guess that's my point.
Yeah. Okay, so then moving on to goodwill. And according to the model, there should be a distinction made between purchased and generate goodwill. Because for purchased goodwill, it is a cost that the acquired firm has spent. It's part of the resource that's being a cost for investors. But for internally generated goodwill, it is not input. Okay, so it is the amount that is considered to be worthy on top of the input cost, measured input cost, but it is also related to what has not been realized. So in my view, or according to the simple model here, it does not belong to the income statement. It does not belong to the balance sheet. So the nature of the internally generated goodwill. So here that is a distinction from the input-output framework. And the next question is, should the balance sheet report firm value in the ideal setting? Well, this is not the case coming from the theoretical context, because you want to know the input and you want to know the output from the operational level first, and then you can assess the value as to the future, about the future activity. And it's not surprising if it's cost-based balance sheet, then the book value will be below the market value, because firms are actively seeking positive NPV projects. But we do need to think about whether the balance sheet has been sort of complete in recognizing as much cost as possible. So that question could be asked. And but it is not going all the way to the level of firm value. All right. Next, I have a few minutes to talk about the income statement. According to the model, what should be the definition of income? Well, income, first of all, according to this context, it is realized output and not future anticipated output. And it is affecting companies or investors' consumption. So this has some implication. For example, accounting gains or losses arising from remeasurement of assets, which are being used for operational purposes, it does not belong to the definition or the criterion here, because you did not really change the physical asset for being used as input for generating your products and to finally achieve value and in the operational context. So that does not satisfy the criterion. And secondly, things like foreign currency translation, when you have subsidiaries outside a country, the gains or losses due to currency changes, it does not belong to it does not satisfy the criterion. But again, I'm talking about the operating activity, not trading activity, which will be a different situation, different story.
Hi, Guochang.
Hi.
Is the realization here has to be just turning to cash flow? So I was thinking about like, no?
No, it's a realized transaction. So but the model is too simple to talk about accrual stuff like that. So, but I'm thinking that, if you wanted to just make it a little bit more realistic, then, some accruals could be included in relation to what has been the asset, the sales realized. Yeah. Bjorn, you have a question?
Yes. So, I mean, I'm trying to operationalize it. So when I have the allowance method, I can either choose percentage of credit sales, or I can choose the aging method. And standard textbooks describe it as if the percentage of credit sales gets the income statement right, and that the allowance method gets the balance sheet right. And so you could imagine that obviously that's true in a sort of limited sense, but you could imagine that you did both. You did the allowance method for the balance sheet, you get the percentage net credit sales for the income statement, and then you stuff the difference into OCI. So there are lots of items where when we face a conflict between matching in the income statement and having the correct measure on the balance sheet between an asset, accounts receivable, and the contra asset, allowance for bad debts, we could fix it by using OCI to achieve both, right? So it's not just limited to these cases. When we think about the boundary between net income and OCI, we should also think about whether OCI could be the slush fund for getting the best of both worlds. Potentially, I'm not saying I want to promote it, but it just seems like that might affect investment decisions by investors if they get a flow measure in the income statement that has good matching and they get a snapshot of the firm. But I don't know.
The model is too simple, too simplified to address these complex accounting issues. Okay, sure. I need to have to acknowledge it. And I try to provide some guidance as to how we should think about net income and the notion of profit, and which is actually not, profit is not defined in the conceptual framework, and the income is defined as, just want to talk about his change in asset liability, rather than giving it an economic based meaning. So I think this is based on, is defined the income based on the consequence, rather than it's the economic meaning. This is what the definition of income in the ISB's conceptual framework. So I think we need to provide some suggestion how to think about how we should define income and how we should define profit in a more direct sense. That is, when users look at this number, they can be more direct. They do not need to go back to think about, okay, what is the definition of asset then? It's a change of asset. But my view is that if we have not resolved the recognition and measurement issues for asset and liability, then these problems will be passed on to profit and income measures, because this is a derivative of those things. Right? So it's just to make it contagious, like spread the problem around the whole financial report. Okay, so where am I? I think time is pretty limited for me. And on the goodwill, I just talked about goodwill impairment, goodwill impairment. And so I feel this is an odd item in the income statement because it relates to future cash flow, future value generation. When you assess there is going to be a decline, expect future cash flow, you recognize some impairment amount. And if you put that into the income statement, it's just going to contaminate the income statement as to what's the meaning of this. Because you have the current period operational result, expenses, revenues, and now you have something in relation to future cash flow, mixing them together. This is not going to make the income number, the profit number meaningful. So I propose to have the amortization rather than impairment method, because the goodwill is part of the investment. It's just like other assets from acquired investor point of view, and then you amortize, and then according to you assess the length of the asset. Okay, so finally, Steve, you want to ask a question?
I'll be very quickly here. Yeah, but you're left with this amortization problem, okay? In the old days, we used to amortize goodwill. And whose guess of the life of it? Analysts routinely added it back. They said, this is junk. It's a bad amortization. So you're ruining your income statement if you have a bad amortization. So the two have to go together. And analysts just ripped it out of there, added it back. Rubbish.
Okay, I agree. There are other problems introduced by amortization, and but before I worry about the implementation level issues, the theory, simple models seem to suggest that that's how we should go about to deal with the goodwill. Because when you do the impairment, you have to be very careful where to put it and what's the meaning of this. We need to at least know what they are, and then we can let the standard setters decide where to put it. And finally, between the two, there should be meaningful interaction, because one is input, the other is output. One should not be the subordinate of the other one or derivative of the other one. They have independent, distinct meanings, and they can be used jointly. And only when they are used jointly can we meaningfully interpret the ability of the firm to perform its economic function. And that is the main message. And I acknowledge that the model is just a starting point. And to think about the financial reporting problem, I have assumed that we have lots of practical things, but I think we can always make more effort to extend the problem, make it more realistic, and then think about some complexities, and then it will be the standard setters to sort of things out and make a final judgment. Yeah. Any more questions? So I am asked to make this announcement for the next ADP event. It will be on December the 16th, 11 a.m. to 12 p.m. Eastern Time. The presenter is Christy Gleason, University of Iowa. The topic is the measurement of quarterly earnings, integral versus discrete method. All right, thank you very much. Ayong, any more final word?
No, thank you very much being on time, and thank you, Zhichen, and thank you everybody for coming today.
Thanks, nice to